Hello, everyone. Today on the final bar, we'll talk market distribution. A bit of distribution today. Heavy earnings week with I feel like the entire S&P 500 seems to be reporting over this couple day stretch. A lot of earnings news, and again, we don't have a lot of time to dig into earnings themes. We're definitely going to dig into the charts. My guest, Greg Guenthner from Agora Financial, is going to take a quick look at small caps. Let us know what he thinks, where he thinks we're headed there. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's episode of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close. Look at the action on the charts, try to connect the short term of today with the long-term trends. And we are right at that. I feel like I've said we're at a crucial juncture many times over the last 6 weeks, but this seems to be the big one. This is where there's a real tug of war between the bear market rally camp, suggesting we have rallied enough. We're seeing enough of a resistance level here. We're at the point when profit taking happens, when the FOMO that has driven this rally is going to expire, and we start this next big leg down. And then on the other side, you have people that are incredibly constructive on stocks, thinking long term. This is people are just missing out. If they're not part of this, we're going to continue higher. So, this earnings week, among others, during this earnings season is really one of those times where you get a lot of catalysts for individual stocks. And the question is, how are companies portraying their ability to manage through this period? What sort of announcements are they giving? And then most importantly, how are investors treating those stocks? So we'll try to break down all the charts that we can in 30 minutes together. Coming up on this show and elsewhere on Stock Charts TV, we have a lot of fantastic guests and experts to put in front of you today. As I mentioned, we have Greg Guenthner from Agora Financial, a really capable, knowledgeable analyst. I'm excited to hear what he has to say about small caps. But next week we have Samantha LeDuc on the show on Tuesday. On Wednesday we have Jonathan Krinsky on Wednesday. On Thursday we have Clint Cowles from TD Ameritrade. On Monday, our next episode of Behind the Chart features Sam Stovall. Sam is someone I've known for a number of years and is a fantastic strategist, not a technical analyst. And I've always enjoyed talking to guys like Sam to think about how my use of the charts, how our toolkit relates to what he's seeing from a macroeconomic geopolitical perspective. So it's a pretty cool discussion. And then our next episode of The Pitch is coming up on May 13th. That's going to feature Grayson Rose from StockCharts moderating a panel of 3 experts sharing some of their picks for the coming week. So a lot of good stuff coming up on StockCharts TV. Let's recap the markets today. So, yesterday was sort of long and strong, finishing higher. We sold off into the close yesterday, but overall, certainly sort of this follow-through update. Today, we sort of get the opposite. We gapped down at the open and chopped around for a little bit. We rallied a little bit in that last hour, but overall, certainly finishing on the weaker side of things. So it was interesting to note the S&P finished just below 1% down, closing around 2912. The NASDAQ 100 actually finishing in the positive right around 9,000, which is a pretty key big round number. That's actually an interesting one. We're going to look at that chart in a little bit later. If you look at the cap ranges, this is a really interesting day to show you what happened. So the S&P 100, the OEX, right, the 100 largest stocks essentially, down third, right, 35 basis points today. Mid caps down 3%, small caps down 4%. So in previous days, yesterday, if I remember right, you had small caps and mid caps up big, the S&P up a couple percent. So it felt like it was a move toward the more speculative, sort of a risk-on environment. That completely reversed today. You had a sell-off, and the big mega cap tech communication services stocks were the ones that held up very well. So the XLC, the XLK, that's communication services and technology, both down around 34 basis points, 0.34%, followed by healthcare. So all 3 of those actually at the upper end. So the mega cap sort of communication services, tech trade held things up pretty well in the markets today. On the bottom, you had materials down almost 3%, financials down 2.5%, followed by utilities and energy. The VIX back up to around 34. It was around 30 yesterday, so it's certainly appreciating as we had a distribution today. Let's look at the chart of the S&P 500, and we'll get to some of the other themes that we've been looking at. So again, what we've talked about on the show is, we've sort of reached that line. We've reached that area, that level where anyone I know who's sort of in the bear market rally camp, and I certainly would say that's where I've been, which is this is part of a distribution phase, and the sell-off in March was the beginning. It's not the end, and I think there will be more backing and filling at the very least. And if that's the case you're making, boy, we're right at that point where it's hard to imagine if we go much further. If we start breaking above 3,000, breaking above the 200-day, you have to just call it a rally and a new bull market phase, to be honest. So I think we're right at that key point where one of those groups is going to feel like they're on the wrong side of things very soon as things sort of go on from here. So the S&P so far now has topped out just above 2950. We're back down just a little bit today. And again, that's just one down day, and that's coming off the 61.8% retracement of this February to March sell-off. That's around 2936. So we're sort of right in that sweet spot. 2930 to 3000 is where most would expect. If you hadn't called a short-term top before now's kind of where you're expecting it. So it remains to be seen how we actually evolve from here. Let's look at some of the other asset classes very quickly. Interesting to see bonds actually selling off pretty well. They're holding up pretty nicely for the first half of the day. So it felt like one of those maybe bonds up, stocks down, but bonds actually sold off to finish down over 1% on the TLT. That's sort of a down move there. Commodities. Gold going down almost 2%, down 1.8%. Silver down a little more at 2%. You had the USO rallying back up 6.5% to be around 19. This just did an 8-for-1 reverse split earlier in the year, and as I mentioned, I was talking back and forth on Twitter with a couple people about this. When something does an 8-for-1 reverse split, that is not the sign of a bull market phase. So as much as you love to think, all right, I think the oil's gone down enough, that usually happens when, you're looking for some stability. You're trying to reset where people are seeing something like oil at. So now it's back up to 19. It was down in the 2 to 3 range there not too long ago. Commodities there, the DBC, which is one of the main commodity indexes we track, up pretty good today, almost 2%. Again, that's driven a lot by oil prices and other measures there. Looking down at stocks, as just a reminder, the number one stock, it's actually jumped around just a little bit, but Newmont Mining at this point remains the number one stock in our large cap scooter ranking. So that's looking across a large cap universe, across sectors and styles to focus on that. And, not a lot of movement in the top 10. There's some semiconductors, some biotech, some financials like Market Access and MSCI. Netflix, Amazon, the two mega cap names really present there on the top. In terms of big movers today, it was interesting to see ABMD actually jump up pretty well. So obviously with earnings, you're going to have big fluctuations, and so a lot of gaps appearing on a lot of charts as investors sort of process what's happening on there. And with a lot of these earnings, it's interesting to see what the movements are, the initial gap, what sort of follow through you get with some of these. But by any measure, ABMD is actually a pretty compelling chart. This is within healthcare, but it's not a group we've talked about as much as part of the medical equipment group. But up 13% today on a good earnings release. This is now breaking above trendline resistance, back above the 200-day for the first time in over a year. Overbought, and again, there are so few stocks that are overbought. It's kind of noteworthy when you have something with an RSI above 70 right now. What's interesting to me, though, is the relative strength that's broken to a new 4-month high. So that's actually pretty significant, right? A nice rally, and that's not just out of nowhere. It's been trying to build a bottom over the last couple of weeks, trying to accelerate to the upside. So we'll have to see with a stock like that, with a chart like that, if it continues continues into that same direction, or if it's more of a quicker move. Down at the bottom, in terms of some of the groups that I think are of interest, some of the groups that went down today within consumer. So you had durable household products down 8%, brewers down 7.25%. This is a group that had actually been doing much better. And again, this is what worries me or what concerns me. What I'd want to remind you, if you're in the long and strong, things are going to be fine. Just keep riding this uptrend camp. I can't argue with you because the trend has been positive. And as long as we continue to make higher highs and higher lows on that short-term time frame, I think you're right to be on that side of it. But just remember, quick moves can happen very suddenly. And when people decide that they're done and they start taking profits, charts can go from good to bad very, very quickly. I think it's one of the advantages of a technical approach is you get a quick read on when supply and demand or when the fear and greed, the sentiment has shifted. And on Brewers, you had a big down move. And again, there are a lot of earnings, other catalysts. I'm more purely looking at the price action. This is a group that's down 7.5% after it was testing the 200-day yesterday, right? So traded above the 200-day, closed back below. Now, this is a group that's been building higher high, higher low, starting to feel pretty good. And then just like that, one day, all of a sudden changes the complexion of the chart very quickly. On a chart like this, I think what you need to do is look back at that previous swing low. And if we do get a bit of a pullback here, I think for a lot of stocks, that's where you have to start to look at support. If they're able to hold those previous lows, maintain that pattern of higher highs and higher lows, things are okay. If not, you have to reconsider some positions. Think if you want to reposition yourself just a little bit. We're not going to get too deep into the breadth picture because we have a segment in a little bit called Banking on Breadth. So I want to save some of those charts for a little bit, but some really interesting movements in terms of stocks above their moving averages, looking at advance or decline or some other things. So we're going to get to that a little bit later. So that's our market recap for a Thursday afternoon here. We're going to take a quick commercial break. Back with my guest, Greg Guenthner. We'll see you in a minute. Hello, everyone. Welcome back to the show. I'm your host, Dave Keller, here at StockCharts.com. As a reminder, we love to answer your questions on the markets, on technical analysis, on decision-making, on patterns, on whatever charting questions you might have. Happy to answer those. Two ways to get them to us. Number one, via email, thefinalbar@StockCharts.com. We get a lot of really good questions along the way there, and we'll hopefully answer some of them tomorrow on the show. Also on Twitter, just tag us in a post at FinalBarSCTV, and we'll take a look at those. And again, tomorrow we'll do our next mailbag segment. We'd love to answer your question on the air. Love to bring on my guest, Greg Guenthner. Greg joining us from the Baltimore area at Agora Financial. Greg, good to have you back on the show, my friend.
Thanks for having me on this very exciting week, Dave.
You mentioned when we got on the phone a little earlier, it is an exciting week. It's a fascinating point because I feel like, people that have been expecting a turn, like it feels like there's this, we're at this capitulation, like something's going to take control here and move us one way or the other, and hopefully give some clarity to what's happening next. Your first chart is of the IWM, the Russell 2000 ETF. What is this telling you about where we're headed here?
Yeah, and this is from yesterday's close. So we do have that 4% drop today that's not reflected on this chart. But I was interested in this chart because, number one, we're right at the 50% retracement from those January highs. So I feel like this could be the make or break. Are we in the real rotation into some of these more speculative names, or is this just the end of a junk rally that's going to roll over right here? Today we did have the big drop. It wasn't that surprising, but I do think it's interesting that it's coming right at this retracement level. And I know earlier this week you mentioned that everyone is either on the bullish train or the bearish train. I'm looking at this and I'm thinking maybe we're in that twist the screws, max pain type area where we're going to get just a brutal chop in between here and those March lows. And so I am looking for this to possibly turn south a little bit, but anything goes at this point right here. This is one to watch very carefully.
It's fascinating. It's such a good point. Someone had once said that the market's going to move, and I'm paraphrasing, it's going to move whatever way causes the maximum pain to the maximum number of investors or something like that. And it feels to me exactly what you said. Going up further from here wouldn't be it. Going down further from here, because either one of those would satisfy a lot of investors. Going nowhere, essentially just chopping around and not having a real direction, maybe the most painful direction of all, right? Sort of that sideways move. Now, having said that, chart number 2 is looking at Zoom ZM. So a particular stock. What are you seeing here?
Well, from a tactical perspective, these quarantine or stay-at-home stocks, whatever you want to call them, have been great trading vehicles for the better part of the past couple months. But Zoom right now, I mean, it flashed almost like the perfect, get out and run signal just last Friday, where you had, the big base breakout that happened in early February, triple-digit gains coming in, and then where I have my arrows there, you have the failure of RSI to get above 70 like it did in March and February, and you have the dark cloud cover there, that ugly candle where you got up to new all-time highs and then closed well within the range of the big candle beforehand, and then you see things start to fall apart there on big volume too. So if you weren't scared out of something like that last week, now you're getting even more pain. It's down 7% today, I believe, another 7% that's not reflected on this chart. Next stop is the 50-day right there, which acted as perfect support back in April. And if it doesn't bounce there, I would say if you have a position or if you're a position trader, that would be the time to get out of the way of this one.
That's such a great chart, and there's a great candle lesson too. By the way, it's almost a textbook example of that dark cloud cover, that distribution, right? Going back to your first chart, Greg. I mean, so let's say that you're right, and we have that painful third direction, that choppy sideways move. If you're, at this point, how do you think of that as an equity investor? Do you look? Is it more of a stock picking environment? Do you just sort of wait? Do you go in? I mean, do you lean more toward cash and just wait to see which way we resolve? And if so, point, like at what point would you sort of give the all clear that we've now made the next step in the new direction? How would you think of this as an investor?
Well, I mean, I don't think that much of small caps, just because they've been underperforming, the major averages for quite some time now. So I do look at this and I say, maybe this is just, the speculative money trying to find some place to go in the last gasp of that. But yeah, I mean, I think if this does continue and we do see IWM continue to play catch up with the NASDAQ or the S&P, then I think it is time to change your tune, obviously. I think it's interesting that if you play around a little bit with these Fibonacci retracements, that if you look back at March, it is matching up with some of those huge gaps. So we have a lot of these massive air pockets in the market right there that we have to work through. If IWM were to, like, say, take out that 141 level and move higher from there, it still has to contend with the downward sloping 200-day. But at the same time, I mean, that's, you've taken out some serious bears along the way there. So I mean, I would need more from this to get super bulled up on small caps. But as we stand right now, I mean, it could go either way.
That's such a great point. When we're thinking of the chart of the S&P 500, I was talking, earlier just about the recap. We sort of hit that, that level, right? That right around the Fibonacci retracements, right around 61.8% retracing that February to March sell-off. Is there a level? Is it where you would feel much more optimistic about stocks? Is there somewhere where you would get we're going to retest the previous highs, which, and again, not to put words in your mouth, but is there something that would tell you things are resolving to the upside? Is it a particular move on something like the S&P breaking above the 200-day or something? Or is it more looking at stocks, looking at small cap participation or, mega cap tech leadership? What would be a signal you would be looking for here?
Well, I mean, yeah, I would like to see the S&P, get above 3,000 and make a significant push and hold it, not just, break above it one day and, say, hey, okay, it's all over. We can all go home and, get long again.
Right.
But
we're going to feel that comfortable again, to be honest with you.
Yeah. I mean, I would also like to see, some better breadth. I'd like to see some more groups, join these leaders. It is nice to see, the Facebooks and Amazons, doing well, but I mean, there were a lot of ugly charts today. I mean, today it didn't look too bad if you looked at the averages, but there were some serious moves lower, and I just like to see some more bullish participation out of these other groups.
It's a great take, Greg. Thanks for answering some of the questions and bringing some great charts with you. Greg Guenthner from Agora Financial. Good to have you back on the show, my friend. Be safe. All right.
Thanks. You too.
That's Greg Guenthner from Agora Financial joining us from the Baltimore area. It's a really good take on where we're at, and again, I think his first point was fantastic, which is, we love to think about market outlooks as a binary outcome, right? We either are bullish or we're bearish. We're either retesting the previous highs or we're retesting the lows. Which camp are you in? And I think that, again, that the most painful direction, I think is right, is we can sort of chop around from here. So if you're short, you never get the validation of making a good downside, making a good profit from it. If you're long, you never really get that indication that we're going to go much further, and we're sort of trapped in no man's land. But again, the charts are the way to figure out which leg is going to be next. So it was a great take from Greg Guenthner. Our next segment is called Banking on Breadth. So what we love to do is look at breadth characteristics in particular, and we talk about them a lot, sort of casually. And if you've tuned into Friday's shows, we do our Wrap the Week segment. We love to bring up some of these breadth charts to get a read on things, but every once in a while I like to focus particularly on the breadth characteristics of the market and try to make sense of where things are coming from, where they're headed. So I'm going to just run through some breadth charts that I include as my regular review, and hopefully spurs some of your own thinking as you're using stock charts, using your charts to break things down. This first one is looking at the S&P 500 at the top. Is a weekly chart, so it's going back quite a ways, actually. Sorry, it's a daily chart, but it's going back, 18 some years, going back to 2002. And here we're looking at the percent of stocks on the NYSE above their 200-day moving average. At the bottom, we have the percent of S&P 500 stocks above their 200-day moving average. And I'm looking at a longer-term perspective just to start to bring in some of those previous, real deep bear market cycles. So this is the 2001 to 2002 low there, the 2008 to 2009 low, and then here's where we're at right now. So if you look at this bottom segment, this is showing you the percent of stocks in the S&P above their 200-day. And what's interesting is, again, if you look over that long period of time, and the same in this next panel, we only really get to the single digits during these deep bear market phases. It's only happened a handful of times in the last 20 years, right? Happened back here in 2011, which, if you just look at the chart, doesn't feel that bad. But I remember when we went to new swing lows, it sure felt like that might be the next big leg down. It felt pretty bad. That first leg down is where we actually went down below 10% of the S&P. The time before that was in 2008, late 2008. This is in October, which was that first real sell-off after this distribution from the '07 high. And then in 2002, again, we went down. It was after 9/11. We kind of rebounded and then came down and made that first major low mid-2002. And that was another one where we went below 10%. So what's interesting is it's in general been, this pattern has been more along the lines of some of these big bombed out bear market patterns. And what's interesting is it's never been on the ultimate bottom. It's always been the first one, right? So this was the '08 low before a deeper '09 low. It was in the 2011 mid-year low before the lower low, and the same thing. It was in mid-2002 before the October 2002 low, the eventual all-time low. So, in terms of the bear market rally camp, this is one of the charts I've been looking at for a while, suggesting that this feels more like a deeper bear market cycle. And the breadth so far has shown you that first leg down. It's not the eventual low. What's interesting though is if you zoom in a little bit. So now we're looking just at the S&P 500. We're looking at stocks above their 200-day, and then in the bottom, this is stocks above their 50-day moving average. So a little bit of a different time frame. And here we're going back around 10 years. I've highlighted some areas just to show how some of these time frames have sort of lined up. If you look at where we're at now, we had the big sell-off, obviously, and then we had less than 10% above their 200-day. We got to 0 stocks above their 50-day. This was last month. Since then, we've rebounded, and now 30% of the S&P back above their 200-day. 76%, so 3 in 4 S&P stocks have gone from below their 50-day to back above their 50-day moving average in a month or less, right? So that's a huge swing, and that rarely happens, to have a sell-off, a huge bombed out number, and then a recovery that goes up above 70%. And the kicker is this: the other times that that's happened, we've had another leg down, right? So the last time this happens was in 2015. Again, the sell-off here versus 2015, very different. That was a much shallower sell-off. It wasn't as deep. But again, we've had the sell-off, we had the bombed out breadth, we had the quick reaction with 70, 80% of stocks. And this is what happened late 2015 before the next leg down. You also had that back here, but the configuration was a little different. We actually had already made a new low by the time we had that rally above 70, 80%. So it really is looking in the last 10 years only like that other time. And again, I hesitate to draw too many one-to-one comparisons and assume that it's going to be exactly like that, but we're certainly showing characteristics more like sort of the first leg down characteristics. Now, in terms of the short-term, more tactical read, and what we talked about with Greg a little earlier, it's interesting to see in terms of participation. The last couple of days, you've had over 70% of stocks closing higher. That makes sense on an up day like we saw yesterday, but even the day before, you actually had a down close on the S&P, but over 70% of stocks closing higher. Today, it actually reversed. You had 75% closing down on the day, only 25% about closing higher. So again, a downtrend is made of a sequence of days with a real heavy hand on one side or the other. Uptrends are made of 80% plus up days, and 90% up days are the real breadth thrusts you're looking for. We haven't seen them yet. Just a couple of other charts I want to highlight, and then we are almost out of time for the show. This is cumulative advanced decline lines talking about breadth. And as I mentioned, regardless of what you think might happen, if you want to understand what has happened up until this moment, we have been in a tactical uptrend. I think that's undeniable, and that's based on the price making higher highs and higher lows. I think that's validated by the cumulative advanced decline lines making higher highs and higher lows as well. I've subjectively color-coded all of these greens as part of my regular weekly routine, just looking at the cumulative advanced decline lines. And again, they just continue to make higher highs and higher lows until that pattern changes. I think the tactical uptrend is still in decent shape going higher. And then finally, I want to finish with this chart. Just looking at the volume. And I think one of the challenges, if you're more longer term bullish here, is that we had the sell-off with increasing volume. We then had a rally on the S&P with decreasing volume. It's interesting to see actually yesterday, you had a bit of a pivot. This isn't updated for today's bar just yet. This is yesterday's bar that you see here. We actually saw an increase in volume, but still making lower peaks. So on those up days, you're getting less and less volume on the upswings. And that is more the characteristic of a more bearish tape. So again, we're really at a compelling point. Breadth characteristics are suggesting short-term strength, but overall, again, lining up very well with short-term strength within bear market phases, and that's how I'm reading, continuing to read some of these charts. We need to wrap the show here. We're just about out of time with the 3 and 3 charts in 3 minutes. So here we go. Chart number 1 is the NASDAQ 100, and it's interesting to see that on a day when the S&P is down, the NASDAQ 100 actually finished pretty well. Actually finished right about flat for the day, if not a little up, and it's right at 9,000. That's where it found resistance after that first leg down at the end of February. Sort of bounced up right to the 9,000 level, and that was it. And we got down to a 6 handle here down at the 4th week in March. We've now rallied and retraced back up to that 9,000 level. And again, there are a lot of moving parts on here. This is just one data point, but I think it'd be interesting to see if this is where you find eventual resistance right there. It's interesting to know that we're already above the 61.8% retracement level, so we're past Fibonacci resistance, but the RSI never really getting above 60. And again, that's more characteristics of bear market phases than bull market phases. Chart number 2 is looking at cap tiers. This is since the market low March 23rd. Did you know that mid caps are actually the top performer out of the 4? Large, mid, small, and micro. Mid caps are actually the #1 performer, up 36% off of the lows, followed by micro caps up 32%, followed by small and large caps right around 30% here. And again, we'll see how as we update this for the close. But interesting to note that mid caps have actually been the best place to be. That was not the case here. Second week in April, we actually saw large caps just starting to overtake it, but then we've again have more of a reversion back towards the mid cap space. And then finally, looking at Microsoft, if you're thinking about the overall market conditions and trying to look at one chart, Microsoft isn't a bad one to look at, only because this has served as quite a safe haven. So it's on a relative basis outperformed so well. Right at resistance from about a week and a half ago. It found resistance right around the 180 level. We've traded back up to that today. Microsoft was up 1% while the average stock was down today. We're near those all-time highs there in February around 190. So we're right at that really key resistance level. If Microsoft's able to eclipse 180, even better, break through the all-time high around 190, that long-term resistance level around 190. that would make me feel better as a bullish investor here. Folks, that's our show for today. Thank you so much for joining us every weekday after the close for the final bar. I want to thank my guest, Greg Guenthner from Agora Financial, for joining us today, sharing his perspective. Please send us your questions, thefinalbar@stockcharts.com or on Twitter @finalbarsctv. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.